So, have you ever watched the news after a big Federal Reserve meeting and wondered, why did the market barely even flinch? It's a puzzle, right? One that actually baffled economists for years. Well, today we're going to crack it open by looking at a really influential paper by Kenneth Kuttner that pretty much solved this mystery and totally changed how we think about the power of central banks.
It seems like a super simple question, doesn't it? I mean, of course they do. This is the Fed we're talking about, probably the most powerful financial institution on the entire planet. When it acts, markets are supposed to react. But what if I told you that for more than a decade, the data showed that this connection had, well, it had pretty much vanished?
And here's the puzzle in a nutshell. You go back to the 1970s, and the link was rock solid. The Fed would raise or lower interest rates, and you could see this clear ripple effect across the markets. It was predictable. But then you fast forward to the 1990s, and something really weird happened. The Fed would make a move, and the market's reaction. It was quiet, messy, frankly, it was statistically meaningless. It was a real head-scratcher for economists.
So, this brings us right to the heart of the problem that this paper tackles, what we can call the Fed's broken lever. For a long time, it seriously looked like the central bank's #1 tool for steering the economy just wasn't working like it used to. And just to put some numbers on this, there was a well-known paper back in '89 by Cook and Hahn that showed just how clear this connection was. They looked at the data from the '70s and found that a 1% hike in the Fed's target rate would reliably, almost like clockwork, push the 3-month Treasury bill rate up by over 0.5%. I mean, it was a textbook cause and effect relationship. But then, when researchers updated this for the 1990s, the whole picture just fell apart. The reaction from that short-term T-bill got cut in half. And for the longer-term rates, the 5-year or even 30-year Treasury bonds, the effect was basically zero. Statistically, you couldn't separate it from random noise. It really, truly looked like the market had just stopped listening to the Fed. So this raised this massive question for absolutely everyone involved in finance and economics. Had the Federal Reserve actually lost its mojo? Did it lose its ability to influence the markets? Or was everyone just looking at the problem the wrong way, maybe missing some crucial piece of the puzzle? And that leads us to the paper's absolutely brilliant insight. The secret ingredient that solved this whole mystery wasn't in the Fed's action itself. Nope. It was all about the element of surprise. Just think about it like this for a second. If you're braced for a pay cut and then you get a raise instead, that is a surprise, right? Well, financial markets work in exactly the same way. They are constantly trying to predict the future. So if everyone on Wall Street expects the Fed to cut rates by a quarter point, and they do, well, that news is already priced in. There's no big reaction. But if the market expects one thing and the Fed does something else, that is new information. That is a surprise. And that is what really moves the needle. So the whole idea boils down to this simple but incredibly powerful equation. Any move the Fed makes can be split into two parts, the piece the market was already expecting and the piece that was a total surprise. The big idea here is that these two components might have completely different effects on the market. Okay, so the next logical question is a tricky one. How on earth can you measure a collective expectation? I mean, you can't just poll every single trader out there. You need a real objective way to measure what the market is thinking. And this is where the paper gets really, really clever. The solution was right there in the data from the Fed funds futures market. You can think of this market as a place where traders are literally placing bets all day long on what the Fed's interest rate is going to be next month and the month after that. It gives us this incredible real-time window directly into the market's collective brain. And once you have that tool, the method becomes beautifully simple. Step 1, right before a Fed meeting, you look at the futures market. That tells you what rate is already priced in. That's your expectation. Step 2, you just wait for the Fed's actual announcement. And step 3, the difference between those two numbers, that's it. That's your surprise. So, armed with this brand new tool that could isolate the surprise, Kuttner went back to the data. And what he found, well, it turned decades of confusion into a signal that was crystal clear. All right, let's look at the before picture. This chart shows the relationship between the total change in the Fed's rate and how the market reacted. And as you can see, it's a total mess. It's just a cloud of random dots. There is no clear pattern here at all. This is exactly that noisy data that had economists so confused for so many years. But now, watch what happens when we apply Kuttner's insight. When we filter out the stuff the market already knew, and we only plot the surprise part of the Fed's move, that random cloud of dots just snaps into a clear, strong, upward sloping line. The signal was there the whole time. It was just buried under all the noise of the expected moves.
This table basically tells the exact same story, just with the numbers. Now look at this middle column, the market's reaction to the anticipated changes. The impact is tiny, statistically it's meaningless across the board. The market basically just shrugs it off. But now look at the column for the surprise changes. The impact is huge, it's significant, and it's powerful. And not just for short-term rates, but all the way out to long-term bonds.
Let's just zoom in on one of these numbers to see how powerful this really is. For every 1 percentage point of an unexpected rate hike from the Fed, the 5-year Treasury yield jumps by a massive 48 basis points. That's almost 0.5%. The connection is direct, it's strong, it's predictable. The Fed's lever was never broken. We were all just measuring it wrong.
So why is a paper from 2001 so important for us today? Because its core idea has become a fundamental principle of modern central banking and finance. It's all about learning how to read and shape the market's mind.
So here are the big takeaways for anyone who follows the economy or the markets. First, it's not the action itself, but the surprise that really matters. Second, this means the Fed's real power isn't just in moving a lever, but in managing what we all expect them to do. This is exactly why you hear so much about things like forward guidance, where central bankers try to signal their future plans. And it also explains why the financial media is completely obsessed with predicting the Fed's next move, because getting ahead of the surprise is literally the name of the game.
And this insight even helps us solve other financial puzzles. For instance, when the Fed delivers a surprise, it tends to shift the entire range of interest rates up or down altogether. But it doesn't necessarily tell us what the next change is going to be. This helps explain why the yield curve, which people often use to predict recessions, can sometimes be a really misleading signal.
And that leaves us with one last big thought to chew on. If a perfectly expected policy move has almost no effect, and all the real power is in the surprise, in the new information, then maybe the most powerful tool a central banker has isn't the lever that changes interest rates at all, but the language they use to manage our expectations about what's coming next.